Good morning, everyone, and welcome to the webinar. We're going to give just a moment for attendees to cycle in, and then we'll begin the presentation. Okay, welcome again, everyone, and welcome to year-end M&A Outlook and Activity for 2021. We're glad to have you with us today. Before I introduce our speakers, a few quick housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to recording as well as the slides and other helpful content. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find that toolbar, just hover your mouse over the top or bottom of your screen and a toolbar will pop up. Now I'd like to introduce our speakers. Pam Busto, CPA, is a partner at LSL CPAs with over 20 years of experience in tax planning and strategic advice for multi-state high net worth individuals and their closely held businesses in real estate, professional services, and wholesale manufacturing. Robert Farnhorst is a director and manager at Plethora Businesses and advises clients in the acquisition and sale of lower middle market companies. At Plethora, he's directly responsible for the completion of more than 60 transactions, including traditional sales, recapitalizations, and mergers. His involvement in these mandates includes deal origination, negotiation, due diligence, and coordination of credit facilities. Rob Connolly is an associate at Plethora and is responsible for helping guide clients through sell-side engagements and correspondingly sourcing strategic and financial investors to accomplish client objectives. He is entrusted with the analysis of financial statements, developing financial models, and in-depth examination of company operations, trends, revenue, and cost drivers, in addition to its competitive and strategic position. So obviously we have a powerhouse here with a lot of information to give you today. And now I want to hand it over to our speakers. Take it away.
Thank you, Jill. To start today's agenda, we're going to be covering the global M&A market, including recent momentum in corporate M&A, private equity's move at the front line of deal making, financing in today's market and its impact on valuations, navigating the COVID business environment, bridging financial gaps and windfall years, effective tax planning and its considerations, and as Jill mentioned, we'll have a Q&A period at the end of the webinar. To start, we're going to look at the M&A market from 3,000 feet up. And the headline for this slide is that the M&A market is very active right now. What this chart represents annually is global dollar volume of transactions in the first 9 months, dollar volume for the rest of the year in the yellow shading, and then number of deals annually in the gray line. So far in the first 9 months of 2021, we are seeing the strongest opening period for mergers and acquisitions since records began in 1980. In fact, the volume experienced in the first 9 months of this year, in the red circled one, is more than any other full year. Why is that, you may ask? Well, there are a number of driving factors. We have record low interest rates. We have pent-up demand from global economies reopening. We have a strong and active economy, a very lofty stock market. There's ample government spending and more anticipated through new infrastructure spending. There's also the X factor with uncertainty around potential capital gains tax increases forthcoming. As I'm sure you're all aware, it was originally proposed earlier this year at a rather steep increase and has been watered down, but still making its round. We certainly don't know where it's going to end up. But I can speak from our vantage point as an M&A advisor that we have been getting a lot of calls from clients wanting to explore a sale because of this issue. I think it's put into motion a lot of owners who may have been on the fence to move forward because of this consideration.
So what does this chart mean for business owners that are not yet on the markets? Our view is that in the near term, the market is expected to remain positive, as well as the current deal pace through next year and most likely through the end of the year. We also believe that there's the potential for company valuations to also increase comparatively in 2022 versus this year. On the deal marketing side, as we've seen on this slide, we're seeing more closings, but more closings also means more available deals on the market. And that's more options for buyers. And we're seeing that buyers are more willing to walk away if the deal isn't just right. In today's market, buyers have the luxury for being more selective. A couple weeks ago, we were into the negotiating process with a buyer, and it was a great fit. It was a strategic fit in the logistics space. And one of the deal team members on the buy side called me and said, hey, our CEO reached out to us. Through their network, they found a great acquisition opportunity in North America, and they want to pursue it. It's a better fit, and they pretty much are kind of postponing all their other deals in their pipeline until they figure out if this one is going to be, the right fit, and if it's going to proceed. Just this week, we received a call from a buyer on another transaction where they said, hey, we're really excited about this opportunity that Plethora is representing, but we are just burdened to the end with transactions, and we do not have the resources to take on any new deals, including due diligence. And so they said, hey, let's push this off to January. So we're kind of in that holding pattern, at least with that buyer, until they can work through their pipeline. So what's the takeaway for you, the business owner? I would say that we are still in a window of exceptional opportunity. We have an environment of premium valuations and healthy multiples. They're out there for business owners thinking of selling. But I'd also say the caveat to that is if an owner is too aggressive in their expectations, that buyers may be more willing to look in other areas and other acquisition opportunities. From this chart here, seeing all this growth, we also want to talk about what could kind of spoil this party. And I think first and foremost, it would be a significant increase in interest rates, where when interest rates go up, the cost of any acquisition is going to increase, and buyers are going to be less aggressive in their offer and their structure. I think the second factor would be a significant correction and or volatility in the marketplace. And lastly would be inflation. As wages and raw materials and transportation costs are all going up, I think we're all seeing that. That gets pushed through the supply chain and ultimately to the consumer level. And if the discretionary spending is not there, then those higher prices are going to get rejected by the consumer, and it's going to create back pressure on the entire supply chain. Go to the next slide, Rob. So we talked about how hot the market is. Let's talk about a couple of the key participants. And in this slide, we're going to speak about the corporate side of M&A and the trends. Public companies right now are in a prime position to be doing deals. They have elevated stock prices, increased profit, and substantial amount of cash on hands. Just this year, going into 2021, there's more than 7 trillion globally of cash on corporate balance sheets. And it's an exceptional number. And I think the primary reason why it's so high is that in 2020, it was a year of conservation. Companies were focused on preservation and enhanced liquidity. There was a lot of uncertainty in the market, and therefore companies held back on their M&A endeavors. But that was last year, and now companies are on a rampage. Corporate deal volume is up 41% this year compared to the 5-year average. And we're seeing that companies have rebounded much more quickly than anticipated. In a way, what we're what we're seeing is that public companies are signaling they can generate better stock returns through mergers and acquisitions than other alternative options like buybacks and dividends. On the financial side, this activity is spurred by cheap financing. Most transactions are leveraged and buyers are taking advantage of this low rate environments, and they are therefore able to be more aggressive. Just a case in point, we have a transaction going right now in the manufacturing space, and the deal value is around 50 million. And on that transaction, we received 14 offers to buy the business. And out of those 14, 8 of them specified that there is going to be no financing contingency required on their part. Buyers either have the cash on hand or they have an established line of credit that's ready to be accessed. So for you, the owner, when you're thinking of potentially going through a sale process, and you might start, going through that and receiving offers on your company, it's always easy to just look first and foremost at price and structure, and that's critical. But then kind of secondary is, hey, who are these buyers, and what sort of unknowns could arise that could derail this deal or potentially delay it? And financing contingencies are one of the major factors. I'll give you 2 quick examples of offers on this deal and how the contingencies were written, and you can decide which one sounds better to you. The buyer is currently investing out of Fund 4, a $200 million committed funds. Based on our experience and strong network of lenders, we are confident in our ability to source the required outside third-party debt. Now here's another offer with reference to financing. Buyer is prepared to provide all of the capital required to consummate the transaction. Accordingly, there will be no financing contingency. So in short, a deal without a financing contingency has a higher probability of closing, and the time to close also decreases.
So outside of corporate buyers, the other most active participant in M&A transactions are private equity buyers. The private equity community, which consists of institutional investors, is well capitalized and is currently supported, as we know, by strong financial markets, and most importantly, a need to use money. It's essential to remember that private equity groups operate with what we like to call a use it or lose it mentality. They raise funds from various sources, pension, retirement funds, endowments, insurance companies, high net worth individuals, and those funds of committed capital come with an expiration date. They need to deploy that capital over a predetermined time period and generate a return for their investors. If they don't, they lose access to that capital and their ability to generate a return for, their investors, of course, but also themselves. Because of this, private equity groups are seeing increased deal activity thus far through 2021. And, I think, of course, the use it and lose it mentality is a reason because of that, but why else are we seeing such an increased amount of activity through 2021? Well, while increased participation from sellers, as we kind of alluded to earlier, I think contributes to this increase in activity. 2 major factors specific to private equity groups themselves would be the low interest rate environment that we are in, as well as record fundraising. So put simply, there is a lot of money flooding the market that, circling back to the earlier point, needs to be deployed. Given these factors, experts are forecasting that private equity groups may represent up to 50% of total acquisition activity in 2022. With interest rates where they're at, it allows private equity groups especially to be more competitive on price and structure when compared to a corporate buyer who historically has been a buyer, through revenue and cost synergies, is able to get more aggressive on valuations. Private equity groups, they'll often finance 50% more or more of the transaction in total value. And with cheap debt, they can get aggressive while still generating their target returns they need to achieve in a transaction. As an example, we had a recent deal of an architectural steel fabricator that was acquired for $21 million. The debt component of this transaction was $17 million, 80% leverage, in what was an already pretty aggressive valuation. The friendly lending market that we find ourselves in today, makes these types of deals possible. Now the question becomes, is private equity a suitable exit option for you, the business owner? Well, I would say yes, assuming they can meet what your objectives are in a transaction. Private equity groups can be a very attractive option for owners who are looking to stay with the company, potentially retain a piece of equity. They can be a great fit here because they often encourage owners to reinvest or roll over 10 to 30% of their proceeds, giving the selling shareholder in this instance an opportunity at the second bite of the apple. This is especially the case when a private equity group is making an investment into a space or industry where they don't already own an existing business. However, most transactions are completed by private equity groups would be categorized as add-on acquisitions. That is the purchase of a business that adds to an existing business they own. Add-on acquisitions typically will provide some complementary service, technology. It may be a new geography or just to scale the business and get cost savings through that way. Add-on acquisitions typically won't have any size criteria in these instances, as opposed to a new investment where it needs to be of a certain size or scale to be an interest to a private equity group. In add-on acquisition situations, the private equity buyer will act similar to a corporate buyer in that they may be able to get more aggressive on valuation because of synergies. They may not need an owner to stay for an extended transition period, and they may not need an owner to roll equity as part of the transaction to make sure they're incentivized to make it a successful marriage of the businesses.
Okay, on the bank lending and financing side, what should we be expecting for interest rates in the near future? We've talked about how rates are low, but that also an increasing environment of interest rates could impact this bonanza that we've been seeing. Well, what we have researched and what our network is telling us is that interest rates are anticipated to remain comparatively low through the end of 2022, with potentially a 1% or more increase by the end of 2023. There could be the potential for 2 to 3 nominal interest rate increases next year. On the financing side, we're also seeing that lenders are taking a much closer look at the financial and cash earning conditions of the business, and especially how companies have performed during the past 18 months. Companies that have experienced a down 2020 will see that lenders and buyers are going to dig a lot deeper to really understand the fundamentals of the business. We all know that a lot of these factors are external to the company and that there's good reasons why a business may have struggled. nonetheless, they may be more difficult to finance, or the interest that you may see from buyers will be at possibly a lower entry price points. We wanted to share this table here with you to give you an idea of what's kind of happened on the deal making front in terms of multiples of the business and multiples of lending. So this table is for privately held transactions that were reported with deal values between 10 and 250 million. And so that first data point is really telling us kind of that rule of thumb, which is, what multiple did these businesses sell at? So TEV is the purchase price of the business, and the EBITDA, of course, is the company's profit. And you can see that before the onslaught of the pandemic, the multiple is around 7.3. And I think without surprise, we saw that dip in the last couple quarters of 2020, and we're starting to rebound as we get into this year through Q2. So the two components of an acquisition are going to be, in this case, equity and debt. And so part of that multiple is going to consist of the lender. And so this next row shows the total debt that is a part of that acquisition. And it gives us an indication of, are banks lending or not in this environment? And the total debt in these transactions has been fairly consistent. Whereas we see the senior debt did take quite a bit of a drop towards the second half of last year, and it's kind of been wavering so far this year through Q2. And I think it's safe to say that senior lenders can sometimes be a little more cautious. They're going to dig a little deeper, whereas total debt might consist of maybe a mezzanine lender where they're going to offset their risk with much higher interest rates, and therefore may still be able to be part of that lending cycle. So for you, the business owner, why is this important? Well, debt is almost always cheaper than equity, and buyers want to leverage as much as they can. So when interest rates are low, it typically becomes more profitable to engage in acquisitions, and company targets that may otherwise be unattractive may now be a net positive deal in this cheap lending environment. We've also seen what's called a quality premium factor, where companies that have performed well these last 18 months are receiving a premium, as in any environment, but we're seeing the premium right now much higher than in prior years. And firms with a trailing 12-month profit and loss that's performing well, along with a clear path for growth, those companies are going to be best positioned to receive this premium. Now, one of the questions that we're asked quite a bit from owners is, well, what happens if we get in a situation where we have an offer on the table, but it comes up short? It's not exactly what I want, to be motivated to sell the company. And there is a way to bridge that gap, and that is through a contingent payment or an earnout, where there's a future payment made to you based on the performance of the business, most commonly in the first, second, or third year following the acquisition. And one tip that I just wanted to share real quick is that an earnout can be based on a number of metrics. It could be, well, we'll pay you based on your revenue, or we'll pay you based on your profit, maybe gross profit. Well, one thing you would want to consider is, you may not be in control entirely of that profit and loss statement once the business is sold, and you want to limit yourself to how much influence the buyer can have over your earnout. And so if you base it on net income, then you have all this cost structure that could be impacted by buyers' decision to, say, grow and invest in the business, which in the short term could lower profit. So ideally, you would want to look at an earnout that would be either based on revenue or gross profit. Rob?
So now we're going to look at kind of the COVID environment. And, comes the question of how has COVID affected the business and especially the M&A climate. And what does that mean for owners who are looking to potentially exit? The COVID-19 pandemic and its effect on businesses in the lower middle market has been significant. As businesses settle into today's new operating climate, there are longer lasting symptoms that we expect to continue to be challenges going forward. We have external factors, namely inflation, supply chain disruptions, and a difficult labor market, among others. Although the Federal Reserve's messaging over the last 12 to 18 months has been that inflation will be short-lived, it has stayed longer than expected and is showing signs that it will likely continue. I think the Federal Reserve's messaging, especially in recent times, has started to convey that message. Companies are facing an increase in many raw material and labor costs that is being intensified with supply chain shortages and increased demand. Many business owners are also facing serious supply chain delays. They have to, adapt, stay nimble in an environment where you may need to, in some cases, purchase material well in advance to ensure you have product to meet demand for your customers. The supply chain disruption that we are in is a result of really several unique issues that are present. And unfortunately, as we all found out, stopping and then trying to restart the global economy and supply chain is a pretty difficult task as we look to reopen. These unusual business conditions and coupled with, I think, just general business slowdowns for some companies, especially during the height and the initial part of the COVID pandemic, resulted in businesses with very atypical financial performances for 2020 and 2021 compared to their historical years. With many owners exploring the idea of selling and exiting their business, how they performed during COVID will be a factor in whether or not it garners a lot of interest in a sale process. If the business performed poorly in 2020 due to COVID, it will be imperative that a solid narrative is crafted to defend its financial slump, while also being able to demonstrate that the business has recovered and it's growing at its current run rate. It's likely that the business will still face challenges and potentially a discount, as buyers will shift their focus and attention toward businesses that have fared well during COVID. Until 2020 and whatever that period is where the business performed poorly is a few years in the rearview mirror, and we now have a longer track record of strong financial performance and growth. In normal circumstances, if sales and profits are flat from a prior year, this can be a negative sign towards buyers and signs of a stagnant business. However, in my experience with businesses today, that were able to hold steady in 2020 throughout COVID, they are attractive in the current environment. As a resilient business that has held steady during what's been a fairly turbulent period for the economy. There is a premium in today's market for businesses that were not significantly impacted by COVID. This is also true for businesses that had slow but stable, measured growth through COVID. Key word being measured growth through COVID, and I say that because if a business overperformed in COVID due to COVID-specific reasons, we have also seen buyers discount that company's performance, expecting it to return to normal, at some point in the future, once we continue to pull away from this environment. An example that we're working with today on a transaction, we're working with a janitorial supply business that has seen business skyrocket through 2020 and 2021. There's huge demand for masks, sanitizing sprays, wipes, filters, different types of PPE, you name it. Their business has grown tremendously. And most buyers in evaluating this business just really aren't quite sure what this business will look like in a year or two from now. Certainly, I think there will be a return to norm at some point, but it's likely to also retain some of this new business that they acquired through the COVID period. Most buyers that we've interacted with have really deployed kind of a wait and see approach, as there's just too much risk in their eyes acquiring a business that has experienced this type of sales volatility and uncertainty around, what will be the business that they ultimately acquire, over the next 3 to 5 years. With all this in mind, it's important to really have a game plan to maximize value if you're looking to explore a sale during what is a very active market. Depending on how your business performed, last year through COVID and how it's performing this year, there will be really a variety of different strategies to maximize value. If you performed, poorly, if it was a down year for certain events, organizing data that supports a defensible narrative to that slump and can identify and articulate it as a one-time event will be key, including things like COVID-related add backs. We all know that businesses went through and oftentimes increased operating expenses for things to make sure they were operating in accordance with certain COVID guidelines that at some point we expect to continue to move away from. If you benefited from the COVID environment and grew significantly, preparing data and an explanation as to why this business will be retained can also help position you to receive maximum value for that growth experienced. These are things that we assist our clients in developing when going to market to get the most value for their business in a process. But above all, it's important to run and organize the business. It's fundamentals in a way that consistently will attract buyers in a market process, regardless of timing. And these are things that we echo to our clients and business owners that we work with constantly. Things like having a diversified customer list, maintaining strong relationships with top customers, but not overcommitting to those top customers. The general rule of thumb is any customer over 20% is viewed as a risk factor to a buyer, where a lot of the business is tied up and concentrated in that one relationship. You want to diversify and spread that out as much as possible. Building a competitive moat by offering additional value add services and capabilities that really create a sticky relationship with the customer. A good example of this is we have a value add distributor that we're working with that operates under a VMI, a vendor managed inventory program, where they will go into the customer's building and will replenish inventory for that customer. They will manage all the purchasing of inventory and making sure that quantities are at predetermined and negotiated levels for that customer. to where for that customer, it's a very hands-free supply chain, versus a pure distributor where, you really are just a transaction. It'll be very hard for that customer to pivot towards another alternative because of how ingrained in their operations, the VMI program is. Working in a business that also does not have too much of the brain trust and operations on the shareholders' shoulders. In the lower middle market space, it's very common we see where much of the business is ran through the owner, the shareholder, and the business value without the shareholder present is much less. Too much is dependent on them being a very active participant in the business. Not only does this, in many cases, create a discount in the buyer's mind, but it makes it very hard to negotiate a quick exit for that owner if that is their objective in a sale, to retire. You also want to have, ideally a consistent trend of growth in the business, growth in sales and profitability, so that the buyer sees that, the business that they are acquiring is a growing business, will generate continued returns of growth for them. The idea of buying a stagnant or a declining business is typically not attractive for an entry point for an investor. Also having accurate accounting. We're working with an electronics manufacturer that, they're currently experiencing a delay in buying components, and they expense inventory. They don't match, costs to revenues in a way to where right now, because they're buying so much inventory in advance to try and meet customer demand, they're a growing business, sales are going up, but their P&Ls are front loaded with so much cost, which is great from a tax perspective, but when they go to sell, they're not positioned in a great way to be able to articulate and illustrate this growth to buyers. And that's why, from our perspective, if not already, we always encourage clients to consider having your financials reviewed or audited annually and organized in the correct way, so that you don't have issues that may be a detriment to you getting the most value for your business, but also there's a premium in the market for businesses that have audited financials. From a buyer's perspective, that gives them confidence that they know that they're not going to find any hairs or any just issues in the financial statements they're getting, knowing that they've been scrutinized to that degree.
With that, the next question is on everyone's minds is, how can you effectively plan for an M&A transaction? So first, you need to plan for how the sale will be taxed. Typically, sellers want to sell stock or partnership interests, which are generally taxed as capital gain, with some exceptions. However, buyers cannot depreciate stock. Instead, buyers typically prefer asset purchases in which some assets can be depreciated or amortized. Sellers are then taxed at both ordinary and capital gain income tax rates, depending on the makeup of the assets sold. So consider your structuring options. Often restructuring before a sale or as part of a sale transaction planning can be crucial to closing a deal that satisfies both the seller and buyer. So you have to consider, how is your business currently structured? Is it a C corporation or an S corporation, or even a partnership, which includes LLCs? Is restructuring needed, or perhaps a tax gross up in sales price to cover increased tax costs to the seller if structured in a way that helps the buyer with future depreciation and amortization, which ultimately helps close the deal? If so, there are many options available to structure a deal that can both make the seller and buyer happy. For example, a partnership or LLC can either be a sale of assets or a partnership interest. A sale of a partnership interest is a capital asset transaction but it could be an asset sale for the buyer, resulting in a higher tax cost to the seller with a gross up in sales price to compensate the seller for the additional taxed cost. This could make the deal more appealing to the buyer. If it's a C or S corporation, again, you must consider if it's an asset or stock sale. Stock sales could be structured as asset sales. The notable elections available to accomplish this are as follows. And please know that this will all be in the guide we provide after the presentation. Both IRC 338H10 and 336E, that's the Internal Revenue Code, allow a buyer and seller to jointly make an election to treat a stock sale as an asset sale for tax purposes. 338H10 is the more common of the two. And if this election is made, only corporate level gain on the deemed asset sale is recognized. The shareholders of the corporation do not recognize any gain on the actual stock sale. If the selling corporation is a member of a consolidated group of corporations, losses from other entities can even shelter the gain from the sale, from the selling party known as the target corporation. A 338H10 election may trigger built-in gains tax for an S corporation that was formerly a C corporation, especially if the sale involves appreciated assets during the recognition period. And currently this period is 10 years for federal and 5 years for federal and 10 years for California. Both types of these transactions are stock sales purchases for legal purposes. However, for tax purposes, they are treated as asset sales and purchases. With S corporations, one concern is that prior to closing the deal, the S corporation must maintain its status as an S corporation. And if the target corporation inadvertently invalidates its S election at some point before the deal closes, the buyer could end up owning the stock of a C corporation instead. Another concern is that there is no tax deferral for partial rollover transactions. This is where the seller maintains partial ownership to keep some skin in the game to ensure the smooth transition. Under IRC 368A1F, you can mitigate the risk of an S corporation inadvertently losing its status as an S corporation. This type of structuring is common in private equity deals, commonly known as an F reorganization. This type of deal allows for a step up in the tax basis of the target's or seller's assets, the same treatment to sellers under 338H10, but without needing to acquire at least 80% of the ownership, and avoiding certain legal considerations that are common in asset purchases. And it allows the target to retain its federal ID number, which is very important to avoid having to revise numerous contracts the target company may have in place. When talking about the purchase price allocation, it should be agreed upon early in a deal structuring. This is key to determine the tax effects of how a deal is structured. But since it is so integral to the overall outcome of a deal to both the buyer and seller, because the seller would prefer to allocate sales price to capital gain assets, such as goodwill, whereas the buyer wants a good allocation for the assets such as equipment or real estate can be depreciated in the future. It's important to agree in concept early in a deal, as it could cause a deal to fail at the last minute if the parties don't come to an agreement. Both buyer and seller need to file an identical Form 8594, an asset acquisition statement, with their tax returns, which puts the IRS on notice that both parties are treating this M&A transaction in the same way. For tax projections, expect your accountant to work hand in hand with an M&A firm and tax attorneys to make sure the deal is as expected. Tax projections are often done during negotiations, including well before closing, at closing, and post-closing. So you should expect your accountants to prepare numerous versions of the tax projections. In a past $30 million transaction we worked on, the buyer purchased 65% of the entity and did not intend to run the day-to-day operations, though they are in the same industry. Since that sale, the remaining 35% owners that they retained sold 3 years later to a new up-and-coming generation who is now running the company day-to-day. For both the original 65% and secondary 35% sale, numerous projections were completed for the sale itself and also to determine the tax impact to the individual owners. And you could also expect that not only is it if you're the selling party, it's your accountant who's looking at it, the buying party's accountants are also looking over those transactions. There's a lot of back and forth. For that transaction, all those projections were updated at various points during the deal negotiation and as the sale approached at funding, and then again during a post-closing period which had lapsed and holdback funds were then released. At all these points in time, it was important for both the buyer and seller to have a complete understanding of the sale, and especially for the seller, what their net cash at closing after all tax costs and fees associated with the transaction had been accounted for. As you can imagine, the seller's attorneys and accountants were also taking a look at all the calculations all along the way. But all of that work does come at a cost. And so what fees can you anticipate for an overall transaction? So in a business sale transaction, as I mentioned, you're likely hiring your accountants, attorneys, a business broker like Plethora, and all these consultants are going to bring in certain expertise to the table that's crucial in getting the deal accomplished that you want. You should also consider exploring an M&A transaction potentially a few years before you actually intend to sell, because you may need to take steps in those years prior to positioning yourself best to accomplish the deal that you want when you want to. If your timeline for retirement or selling the business is a few years out, it's always a good idea to reach out now and get some information rather than waiting until the moment when you've had it and you're ready to pick up your golf clubs every day. So considering that your business may be your most valuable assets, even above perhaps your homes that you own, it makes sense to hire the right team of advisors to get to the best outcome. So for example, in that $30 million transaction I described earlier, the total advisory costs were about $500,000, but overall that was only 1.6% of the sales price. And when we compare it to what we typically think of paying for any real estate sale, between 4 and 6% of commissions, and I guarantee in these deals you need the best advisors at your side. So this isn't necessarily an area where you're looking to do cost-cutting measures. You may even need to switch accountants or attorneys. I've seen that happen as well. So moving on to whether or not tax legislation and how this will change your plans going forward. Recently, and this is hot off the presses, just last Friday, a bipartisan bill was passed by the House, $1.2 trillion infrastructure bill. It's called the Infrastructure Investment and Jobs Act. It was split off from the other part of the bill just recently, and so that the Democrats felt it was best to split so that they could move forward on one part of it. This is what's commonly known as the spending bill, and it's headed to the president's desk for signature now. It was passed with a vote of 228 to 206, with 13 Republicans voting yes and 6 Democrats voting no. That leaves the 1.5 to 1.85 trillion reconciliation Build Back Better bill. The number varies because, as you can imagine, it's still under consideration. It keeps the number, depending on which source you look at, the numbers are being counted a little bit differently in different news organizations and on the Hill. It's expected that there will be changes, causing it to go back to the House to be voted on again before it become law. And this is the bill that contains specific tax items of most interest to business and individual taxpayers. So how will these bills affect your structuring decisions? Next slide, please. Time, of course, will be fully needed to understand the final passed legislation if they can get it signed. Last I had heard, their goal was to have this signed by the 15th of this month, but 4 days from now, we'll have to see. The current draft does contain a provision that limits excess business losses of non-corporate taxpayers. It does not presently include an increase in the maximum long-term capital gain tax rate, which is currently 20%, or the marginal income tax rate to increase them back to the maximum 39.6% for individuals that existed prior to the 2018 tax law changes. But both these ideas have previously been considered and could easily be considered again in future bills. However, it does include a surcharge on high-income individuals, estates, and trusts, which applies for tax years starting after 12/31/21. This could affect the owners of larger deals who sell in 2022 or later. It includes a 5% surcharge tax on modified AGI that exceeds 10 million, plus a 3% surcharge tax on modified AGI that exceeds 25 million. And modified AGI means AGI reduced by investment interest expense under section 163D and business interest expense under 163J. And both of those have their own limitations under the code. Sales of qualified small business stock of C corporations would also be affected under the Build Back Better bill. This will be an important consideration for those selling QSBS stock who are counting on a higher exclusion. It eliminates the higher 75% and 100% exclusion for taxpayers with AGIs of 400,000 or more. So this is a severe limitation and may come as a shock to business sellers of any deal that exceeds, puts the seller over 400,000, which is not difficult to do in these deals. Additionally, the SALT limitation, commonly known as SALT, but it's the state and local tax limitation, was modified under the Build Back Better bill. And it hasn't allowed a provision which brings back the state and local tax deduction above 10,000 on individual returns to a new limit of 72,500 for 2021 for married couples, which gradually would increase to 80,000 for married couples over a decade. For those closing small M&A deals in low tax states, this deduction will help ease the burden if their SALT deduction had not been previously maxed out. I want to thank everyone for joining us today. Jill's going to see if any questions have come in during the presentation that we can answer for you now.
Thank you, Pam. It looks like we do have a few questions that came into the chat. So it looks like these will be for Rob and Robert. The first one is, when I sell my business, how long should I expect to stay to transition to the new owners?
Sure. So the answer to that question would really be, highly dependent on the company. I can say broadly that most transactions would consist of, a transition period of roughly 3 years plus or minus. Situations where the owner is in a completely passive role. They've removed themselves from the business. They've organized it in a way to where it operates really without their involvement whatsoever. You may be able to exit day one. On the other side, I've worked with clients that were very heavily involved in the operations of the business, where every single buyer we ever brought to the deal was needing the owner to stick around for at least 3+ years, and in many cases wanted that owner to retain a piece of equity or remain on as a partner, so that they could make sure that they were incentivized for the future success of the business. They want to make sure that there's some skin in the game, that if they call, that you'll pick up and want to help and make sure that the business continues to grow and do well, because they are just so involved in the business. So roughly 3 years plus or minus, but it's always highly dependent on how that business is organized, with respect to how necessary is the owner for the success of that company.
Yeah, just to add to that, when Rob said that he, the transition could be as soon as day one, he's not joking. We had a company a couple of years ago where I think we funded on a Friday, like 9 a.m. So seller received their proceeds at around 9 a.m. and he ordered lunch for the employees, got everybody in the room, in the office, said, "Hey, I sold my business. Here's the new owner, and thank you for everything and good luck." And that was it. He was out. So it can be that fast, but that was a company that had a couple key employees, a president already there, a CFO. So they had the infrastructure, and the owner kind of even admittedly was like, "I'm more the cheerleader." So that could certainly happen. If you do one out soon, and we see this from a lot of founder owners that had the company 20, 30 years, they're over it, they're done, they want out. It's a little bit about finding the right buyer. So you could have the same transaction that two separate buyers look at it and they take issue with the infrastructure in terms of management. So sometimes it's just, hey, maybe we find the right strategic buyer. They've got the people on their side that can quickly plug in their people and take over quickly. And like Rob was saying, just a consulting or a transitional period to help out to get through that may be all it takes to finish the sale.
Thank you. Looks like we had a couple more come in. Robert, do you want to look at those and see? I think we have time for one more. You want to take a look?
Sure.
Robert?
I think we
I
have 5
actually
minutes.
see the question about assets and how does real estate factor into the process, and with a company-owned building, I can comment on that and they can add something if they like. So what I see is that in business purchases, so say for example, the company owns the building as well as the operations of the business, the buyer may come in and have 2 separate entities buy the assets. They might form a separate LLC to buy the real estate that is integral to the business, and then another entity separate from the LLC would buy the operating assets of the business. So that's very easy to accomplish, even if the current structure is that the real estate's kind of commingled in the same operating entity. The buyer can accomplish that separately, but just carving out 2 different transactions.
Yeah, definitely. We do a lot of transactions. It could go either way, where it's essentially a company-owned real estate property. A lot of times they're just leased. I would say make sure that the lease that you're charging yourself or charging the company is within market. And if you have expectations to increase your rent once you sell the business, that we would have to make sure that's accounted for in the overall valuation of your business.
Okay, and it looks like we have time for one very last one. Should I keep investing in my business if I plan to retire in the next couple of years?
Well, our general recommendation is you don't want to take your foot off the gas. So if you're looking to sell the next 6 months to a year, definitely talk to your advisors to look at what it is you plan to invest in. But I'll say that there's kind of 2 types of investments. There's the normal capital expenditures that you incur every year, and then you've got sort of growth initiatives that might be an upgrade to an accounting software. Buyers look at that, they see value in it, and time is money for everyone, including the buyer. And if they see you're making investments that will make the transition easier and allow the buyer to really jump into this company and start growing it from where it's at, then I think you'll see dividends in that. We've also had transactions where the basic capex, like a trucking company, they invest in new trucks and trailers every year, and then the year they're selling, they don't invest at all, and the buyer's going to get in there and go, "Come on, we see what's happening here. You saved yourself $5 million in investment, but we're going to be footing the bill for that." So those types of things can rear their heads in due diligence. And so again, I think you want to talk to your advisors like Plethora, like LSL, and figure out if it makes sense to take on those investment initiatives.
All right, and with that, I think we'll wrap things up. We want to thank all of you so much for attending today. Of course, if you have any questions at all, please feel free to contact your LSL partner or manager. And you can also contact Rob or Robert at Plethora directly as well. We will be sending out an email later today with a link to this webinar recording, as well as the slides and a couple of other helpful pieces of content from the Plethora and LSL team. So thanks again for joining us, and make it a great day, and we'll see you next time. Thanks.
Thank you.
Thank you.
Thank you.